On September 15, 2008, the fourth largest investment bank in the United States filed for bankruptcy. It was not just a bank failure. Within 24 hours, credit markets around the world froze. Stock markets in every major economy collapsed. Banks stopped lending to each other. Companies that had nothing to do with finance or mortgages or Wall Street suddenly could not make payroll. 8 million Americans lost their jobs. 6 million lost their homes. $25 trillion in household wealth disappeared globally. One bank, one weekend, the entire world economy brought to its knees. This is the Lehman Brothers story. And it did not start in 2008. It started with a decision made years earlier to bet everything on a market that everyone assumed could only go up. Lehman Brothers was not a young company. It was founded in 1847, before the Civil War, by 3 brothers from Bavaria who opened a dry goods store in Montgomery, Alabama. They began accepting cotton as payment from local farmers, discovered that trading commodities was more profitable than selling goods, and evolved over generations into one of Wall Street's most storied investment banks. By 2007, Lehman Brothers had survived the Civil War, 2 world wars, the Great Depression, the 1987 crash, the dot-com collapse, and the September 11th attacks. It had 26,000 employees, $639 billion in assets, and a stock price that had made its CEO, Richard Fuld, one of the most powerful figures in American finance. Fuld had run Lehman for 14 years. He was known as the Gorilla, a nickname that reflected his aggressive, combative management style and his absolute belief in Lehman's ability to outcompete any rival. The belief that had made Fuld successful was also the belief that would destroy the company he had spent his career building. In the early 2000s, the American housing market was booming. Home prices were rising every year. Banks were issuing mortgages to an increasingly wide pool of borrowers, including borrowers with poor credit histories, no income documentation, and minimal down payments. These were called subprime mortgages. Wall Street had found a way to turn these mortgages into financial products. Banks would bundle thousands of individual mortgages together, slice them into tranches based on risk level, and sell them to investors around the world as mortgage-backed securities. Rating agencies gave many of these products AAA ratings, the same rating as US government bonds, despite the fact that the underlying mortgages were being issued to borrowers who had no realistic ability to repay them if housing prices stopped rising. The entire system worked as long as housing prices kept going up. If a borrower defaulted, the bank could foreclose and sell the house for more than the loan value. The losses were always manageable. Nobody seriously asked what would happen if housing prices went down. Or rather, the people who did ask were told they did not understand the market. Lehman did not just participate in this system. Under Fuld's direction, they ran toward it in 2006. Lehman Brothers made a series of acquisitions that transformed them from a bank that traded mortgage securities into a bank that originated them. They bought BNC Mortgage, a subprime lender. They bought Aurora Loan Services, another subprime originator. They built an enormous commercial real estate portfolio. They increased their leverage, the ratio of borrowed money to their own capital, to levels that meant a relatively small decline in asset values could wipe out the entire firm. By 2007, Lehman was leveraged 30 to 1. For every dollar of their own capital, they had borrowed 30. In practical terms, this meant that a 3% decline in the value of their assets would make them insolvent. The people inside Lehman who raised concerns about this were sidelined or ignored. One risk officer who pushed back on the real estate exposure was reassigned. The culture Fuld had built rewarded aggression and punished caution. In 2006, the US housing market peaked and began to decline. The decline was slow at first, then it accelerated. Subprime borrowers who had been issued mortgages with no documentation and no realistic ability to repay, began defaulting in large numbers. The mortgage-backed securities that had been rated AAA began losing value. The models that Wall Street had used to price these products turned out to be catastrophically wrong about the correlation between defaults. They had assumed that defaults in one region would not coincide with defaults in another. In a national housing decline, every region defaulted simultaneously. Bear Stearns, another major investment bank with heavy subprime exposure, collapsed in March 2008. The Federal Reserve and JP Morgan Chase organized a rescue. Bear Stearns was sold to JP Morgan for $2 per share, a fraction of its book value, with the Fed guaranteeing $30 billion in troubled assets. Lehman watched Bear Stearns die and concluded they were different. Fuld spent the spring and summer of 2008 telling investors, analysts, and employees that Lehman's balance sheet was strong, that they had adequate liquidity, that the worst was behind them. He was wrong on every count, and the markets knew it. Lehman's stock fell from $66 in January 2008 to less than $4 by early September. Short sellers were betting heavily against the firm. Counterparties, the banks and institutions that Lehman did business with every day, were quietly reducing their exposure. In the first week of September 2008, it became clear that Lehman needed a rescue or it would fail. Fuld reached out to potential acquirers. Korea Development Bank had been in discussions but walked away. Barclays expressed interest. Bank of America looked at the books. On the weekend of September 13th and 14th, Treasury Secretary Hank Paulson convened an emergency meeting of Wall Street's CEOs at the New York Federal Reserve. The message was blunt. The government would not bail out Lehman. A private sector solution was required. Bank of America chose to acquire Merrill Lynch instead, another firm on the brink, leaving Lehman without a buyer. Barclays remained interested, but faced a regulatory obstacle. British regulators would not approve a deal without a shareholder vote, which would take weeks Lehman did not have. On Sunday night, September 14th, with no buyer and no government rescue, Lehman Brothers had no choice. At 1:45 a.m. on Monday, September 15th, 2008, Lehman Brothers filed for Chapter 11 bankruptcy. The filing listed $613 billion in debt, the largest bankruptcy in American history, nearly 6 times larger than the previous record. It was not a contained financial crisis. It was a global economic cardiac arrest. Within hours of the Lehman filing, money market funds, investments that millions of Americans used as essentially risk-free savings accounts, began reporting losses. The Reserve Primary Fund, one of the oldest money market funds in existence, announced that it had broken the buck. Its net asset value had fallen below $1 per share because of its exposure to Lehman debt. The announcement triggered a run on money market funds globally. Institutions and individuals pulled hundreds of billions of dollars simultaneously. The commercial paper market, the short-term borrowing that companies use to fund day-to-day operations like payroll and inventory, froze completely. Companies that had nothing to do with mortgages or Wall Street suddenly could not borrow the money they needed to operate. The stock market fell nearly 500 points on September 15th. Over the following weeks, global equity markets lost approximately 30% of their value. Iceland's entire banking system collapsed. Ireland, Spain, and Portugal required international bailouts. The unemployment rate in the United States rose from 5% to 10% in 12 months. The US government, which had refused to rescue Lehman, immediately reversed course and began the largest financial rescue in American history. The Troubled Asset Relief Program injected $700 billion into the banking system. The Federal Reserve slashed interest rates to near zero. AIG, the insurance company that had insured trillions of dollars in mortgage securities, received a government bailout of $185 billion. The rescue worked, eventually. The economy stabilized. The banks survived. The stock market recovered over the following years. The people who lost their homes did not recover. The people who lost their jobs did not all find new ones. The communities built around industries that collapsed in 2008 and 2009 are still, in many cases, recovering today. Richard Fuld was never criminally charged. He lost most of his personal wealth, primarily Lehman stock, in the collapse. He has given occasional interviews over the years in which he maintains that Lehman was treated unfairly, that the government's decision not to rescue the firm was a mistake, and that the bank could have survived with proper support. He is not entirely wrong about the last point. The decision not to rescue Lehman while rescuing Bear Stearns and AIG was inconsistent in ways that regulators have never fully explained. Whether a Lehman rescue would have prevented the broader crisis or merely delayed it is a question that economists still debate. What is not debated is the cost. The 2008 financial crisis produced the deepest global recession since the 1930s. The recovery took years. The political consequences, the anger, the distrust of institutions, the sense that the people responsible had escaped accountability, shaped the political landscape of the following decade. So what is the lesson of Lehman Brothers? It is not simply that leverage is dangerous, though it is. It is not simply that housing markets can decline, though they can. The lesson is about the relationship between confidence and catastrophe. Every decision that led to Lehman's collapse, the leverage, the subprime exposure, the refusal to raise capital when they had the chance, was made by smart people who were completely certain they understood the risk. They were not ignorant. They were wrong in the specific way that very successful people are wrong. They had been right for so long, in so many markets, that they could no longer distinguish between understanding risk and being too important to be affected by it. Lehman Brothers survived for 158 years. Wars, depressions, crashes, attacks. It took 14 months of unchecked confidence in a rising housing market to end it in a weekend. The building at 745 7th Avenue in Manhattan, Lehman's headquarters, still stands. Barclays bought it as part of the asset sale after the bankruptcy. The nameplate is gone. Everything else looks exactly the same.